Hey everyone, it's John with the Practitioner's Brief, and we're coming off another hot month of equity market performance. The S&P 500 up 3.5% in the month of September, really led by the Magnificent Seven once again. Specifically, big performance out of Tesla and Google, up 33 and 14% respectively. Pretty solid performance in small caps, up 3%. The average stock, however, not so hot. The S&P 500 equal weight, which neutralizes the impact from the size of the Magnificent Seven, only up about 1%. And so you really had stark performance across equity markets. The markets, again, continued to be carried by these giant technology companies. And so it's really a tale of two stories. And I talked about this last month, where it's AI capital investment and interest rate cuts, right? And that's fueling that barbell impact of large cap technology stocks and small cap stocks, both working in tandem. We also have to look at the gold market. Gold up over 11% for the month. The gold miners up 20%. And so we're really starting to see this parabolic price action in individual securities. You're starting to get this almost vertical price action. Again, I go back to what I talked about last month. It's really this AI capital investment theme and interest rate cuts. And so I think you have this market where the capital expenditure expectations continue to climb. And we had some notable news this month that we're going to get into and talk about how do we position around some of these notable news events. Interest rate cuts, we had one cut last month and two more planned for the rest of the year. If you're not going to benefit from either this AI capital investment theme or benefit from interest rate cuts, the market wants nothing to do with the security. When we have two very specific market dynamics driving very narrow sections of the market, it really starts to give late market cycle vibes. And is that the bottom of the eighth? Is it the bottom of the sixth? What inning are we in? How close we are to the end of this cycle? I think that's anyone's guess, but it's important that we heed these warnings and pay attention to some of the clues that the markets are giving us. And there's two very specific clues that we want to pick up on. One being the continued lack of progress of efficiency gains in the workplace by generative AI tools, and the circular revenue that's being created by some of the AI capital expenditures. So starting with the workplace, we're talking about the lack of progress with the efficiency gains by generative AI tools. And last month, MIT reported 95% of organizations are seeing no measurable return on their AI investment. And then this month, Better Up Labs, in collaboration with Stanford Social Media Lab, reports a productivity mess that's being generated by AI tools. And they coined the phrase work slop. And work slop is AI-generated work content that masquerades as good work, but lacks the substance to meaningfully advance a given task. I think we can all resonate with, we kind of tinker with these tools. They may help us out from time to time, but it's not really creating these big, broad efficiency gains, at least not yet. And for me, this is a time, leadership, cultural issue that's going to take time to manifest itself into big, broad efficiency gains for the economy. So we're continuing to see this narrative of a lack of productivity gains in the workplace by some of these tools. And actually, you're creating some inefficiencies with some of these generative AI tools. And so it causes me to question the pace of this investment. Is it too much, too soon? And when can we expect a reasonable or sizable return from these investments? In September, we saw a few deals that really just threw up some warning lights for me, and it created this circular revenue story. There's two deals. NVIDIA committed $100 billion to invest into OpenAI. OpenAI signed a $300 billion 5-year infrastructure contract with Oracle. And for me, this really gives off some dot-com bubble vibes. And, essentially, NVIDIA invests into OpenAI. OpenAI commits to contracting with Oracle. Oracle has to build this infrastructure. And what does it need? It needs NVIDIA chips. And so you're starting to see this circular revenue story come into play because, again, the market works at the margin. It's not just about capital expenditures maintaining. The market wants to see it accelerate. And that's just not feasible. And so you're starting to see these stories where these contracts are getting bigger and more grandiose, and it really has to fit this theme of more and more and more investment. And I think Michael Semblis at JP Morgan really put it into life when he wrote in his Eye of the Market, Oracle stock jumped by 25% after being promised a $60 billion a year from OpenAI. an amount of money OpenAI does not earn yet to provide cloud computing facilities that Oracle hasn't built yet and will require 4.5 gigawatts of power, the equivalent of over 2 Hoover dams or 4 nuclear power plants, as well as increased borrowing by Oracle, whose debt to equity ratio is already 500% compared to 50% for Amazon, 30% for Microsoft, and even less at Meta and Google. And so the pure size and scale of this project is kind of mind-boggling. Mark Zuckerberg was interviewed as well, and he really comments to the theme of this time period. And he says the risk, at least for a company like Meta, is probably not being aggressive enough rather than being somewhat too aggressive. And so for me, when I start thinking about what inning we're in this cycle, when you're starting to hear this language, you're really starting to get to the point where these companies are doubling down on their commitments to invest. They're not backing away. And for me, that just gives more room for this to get a little bit more silly. And it's tricky to manage this dynamic at this point in the cycle. And so I really encourage viewers and readers to reference back to what I wrote in the August practitioner's brief, was about structuring that barbell approach, where you do have maybe some of this AI investment because it can continue to run, and maybe you're pairing that with some non-AI related investment because there is room for this to continue to expand. So my message is really one of just nuance and perspective. And I think for most that aren't trying to just trade through this and are really trying to be disciplined investors, it does become challenging to navigate some of these market dynamics. And anyone that's calling the top or calling this a bubble, it really is not helpful because it's, what do you do? How are you supposed to manage through this? Because again, it's a marathon, right? There's not really an end date in play for most people. And so what we're thinking about is, how do we maintain an investment posture through and the end of this cycle? And it becomes to get more and more complicated as the performance gets to be even stronger and even narrower as it continues. And so it's really just a message of discipline and have a process. If you are nearing retirement, it becomes a little bit trickier for you because you're going to start taking distributions. And if you're taking distributions into a downturn, that could be problematic if they're not properly positioned. So the message is, be disciplined, stick to your plan, and if necessary, get some qualified advice. So I'm really excited about this month's planning piece, and it's about the timing of Social Security benefits and structuring your retirement distributions from your investment assets. And it really was spurred on by a researcher on Kitces.com. His name's Derek Tharp, and Kitces.com is a financial planning resource for us nerds. It's really used by industry professionals, and he really questions the methodology that's used for determining when to take your Social Security benefits. And that decision has largely been a quantitative decision, right? Pretty much, you tell me when you're going to die, and I'll tell you when to take your benefits, right? And if you're going to live past 81, 82, typically you wait till 70, and that's how you maximize the total amount of income that's paid out to you. And now that comes with a lot of other nuance, because if you're taking your Social Security benefits at 70, you're retiring at 65, you're funding those years of retirement through your assets. And so there's a lot of math involved determining taxes, total lifetime wealth. But Tharp's point was, we're missing the qualitative perspectives of when to take these benefits. And I totally 100% agree. I feel like our industry has been fantastic at getting people to stay invested, or we're getting much better at it, invest through market cycles and deal with volatility and accumulate. But we've done a pretty poor job of helping people actually spend and really maximize and enjoy their quality of life, especially in retirement. And so my message for my clients, and really for anybody that's listening, it's retire, spend, and give, and do it when you're healthy and you can enjoy it. So my two focal points in the piece were health spend, prioritizing enjoying your money during your earlier retirement years, and recognizing your spending behavior patterns. And what we've seen is that retirees just don't spend their money. And there's some recent research that's been published that's looking at some retirement households, and a 65-year-old married couple is distributing about 2% of their retirement assets. And that's really half of that typical 4% withdrawal rule that is kind of a general rule of thumb. And what's kind of most significant to me when I'm reading this research is that spending ticks up a little bit as retirees are entering their RMD, those required minimum distributions, you start to see spending tick up. Now, that's actual spending. That's not just referring to the distributions. So retirees are increasing their spending modestly when they get to their RMD years, and it's like subconsciously they're seeking permission to spend these assets, right? And I think deep down there's maybe some subconscious fear of being poor again or leaving your spouse without if you were to be the first one to pass. And so I think with a good planner and some solid investment advice, it's really our role is to help individuals feel comfortable to maximize their quality of life, maximize the joy that they're going to receive in their retirement years. Because you're not going to take it with you. And what we see is your spouse doesn't generally spend it either, and it ends up getting a bequest to your children who, in my experience, have mostly moved on from the most challenging parts of their lives where they're dealing with the high expense mortgages, raising children. There's no real strategic planning in the bequest. And so it's really important that we start to bridge that gap to help folks spend and to maximize their quality of life. And so what this is not permission to go take your Social Security at 62. It's not permission to go buy a Porsche. It's really permission to really start to factor the non-quantitative aspects of your life in when you're taking your Social Security, how and when you're distributing your assets, when and how you're giving. And it does not have to just wait until you pass away. These things can be done in a very responsible way throughout your life so you get the most joy out of it. And so I highly encourage you to work with a qualified professional so you can get the most out of those assets you worked so hard to accumulate. So that's this month's practitioner's brief. My contact information is in the description of the video, and the full length written brief is in the description of the video as well. I personally prefer the written version. I feel like I can communicate much more clearly, but you kind of have your choice. I think it kind of is a good pairing, you know, maybe not like wine and cheese, maybe more like mustard and hot dog, but you kind of get the idea. Thanks for watching.